Okay, I guess good afternoon or good evening, everyone. We'll figure out the exact details in a second. My name is Gordon Einstein. I'm happy to be part of this D4A, Democracy for All, or Democracy for Governance conference, virtual conference. Our topic for this panel is on the way to central bank digital currencies, or Money 2.0. I have some esteemed panelists who I'm actually happy to meet participating in this conversation. And just reading their titles, I'm impressed. So, I saw a small smile when I said that, but it was only a small smile. So we'll get so just real quick about me. I'm Gordon Einstein. I'm a lawyer. I focus on crypto and blockchain law exclusively. I'm located out of Los Angeles, but I really want to get down to introducing our guests. Unfortunately, Yaliwi Soko from the United Africa Blockchain Association, I gather, is a little bit ill, so she won't be able to join us. But let me start with Johnny Fry, Team Blockchain. Tell us about Team Blockchain.
Hi.
And yourself, of course.
Yeah. My name's Johnny Fry. I'm CEO of a company called Team Blockchain. My background is I set up and ran a mutual fund company called Premier Asset Management here in the UK and floated it on the London Stock Exchange. We had a series of funds in London, in Luxembourg, in Canada, and in the good old USA. So think of 401ks, mutual funds, that's what we did. Did that for around about 25 years. And then about 10 years ago, got involved. I decided I wanted to do something real and tangible rather than just shoveling bits of paper. And about 5 years ago, I got involved with looking at the technology of blockchain, sucked into a bit of a rabbit hole. Wasn't interested in cryptocurrencies per se, but liked the idea of the technology. So having come from a traditional financial background, I was interested in how you could use the technology and actually start digitizing assets. So I think the opportunity to digitize real assets, commodities, property, bonds, equities, driven by compliance and regulation, because I cannot see how we are going to have in 5 years' time an analog market whereby you only know who are your shareholders once a day when the markets are shut, where the regulators don't understand systemic risk because they're just bogged down with information, as opposed to a digital market where you've got 24/7 trading. It's much more inclusive and actually gives you much stronger risk and compliance controls. And so off the back of this, we now write something called Digital Bytes, which is a weekly publication looking at how, where, and why blockchain technology and digital assets are being used in multi-jurisdictions and multi-sectors. And one of the key topics in the last 2 or 3 months has been central bank digital currencies. Clearly, the Chinese have been first out the gate. There's a lot of chat going on here in Europe about seeing a digital euro. And eventually, Uncle Sam is beginning to wake up, if you look at Wall Street Journal headlines, because the US dollar is no longer going to be the world reserve currency within 5 years. And that's quite natural. Every 100 years we have a shake-up, which we can get into and talk about with the previous reserve currencies.
So, I'm already going to break in and break format and ask you something. It won't be a reserve currency, or it won't be the reserve currency?
It will not be the reserve currency. Basically, you've got nearly 4 trillion of cash sloshing.
We'll get there. I just want to tease out whether that was a definite or indefinite article, because that makes a big difference.
Oh, so, typical lawyer. Get down to semantics already.
I'm just giving you credit for having well thought out thoughts, and you have one. So that was good.
Very much. My sister lives in LA. I love the States, but Uncle Sam's time as the dollar may have come to pass in the same way that old Lizzie had to hand over the pound sterling to Uncle Sam before. But lots of history, which we can get into in a minute.
We'll get into it. I just wanted to tease, I just want to be clear. There is an argument for it won't be a one, but we'll get there too. All right. I'm gonna move on, I believe, and we'll come back, of course, to Joshua Goodbody. Then you know what? Then I'm gonna make a terrible joke, but if you're still Goodbody after COVID, congratulations. I'm Gordon Homebody these days.
Yeah, I'm more homebody than Goodbody at the moment, but we do what we can. Yeah. Lovely to be here, Gordon. Thanks for having me.
Sure.
As you mentioned, my name's Josh Goodbody. I'm the Director of Growth for Binance. I'm based in London at the moment. So Binance, as I'm sure many of you all know, is a large digital asset ecosystem provider. We do a number of things, including cryptocurrency exchange providing and different kind of ancillary blockchain-based services, whether it's DeFi or CeFi. So, my background is actually originally as a financial markets lawyer. A bit like Johnny, I spent most of my career in the traditional markets, mainly on the derivative side of the market, advising sell-side and buy-side institutions how to build trading infrastructure, how to launch different derivative-like products.
This is in private practice or?
This is in-house mainly, actually. This is in-house, yeah. So
I spent most of my exchanges helping them figure out.
At exchanges and trading platform providers. So a bit like in the US, you have CEFs. In Europe, we have MTFs. So mainly working in the MTF space. So I came at this from another angle, which was, I saw, all of these traditional market infrastructure providers and thought, there's a fantastic opportunity to disrupt this market in some way, shape or another, whether it's at the asset level, whether it's the way that it's traded, how things are distributed globally. So I came at this, very much from originally a markets perspective, thinking, blockchain is going to disrupt and really diversify the way that the assets are traded and sent across the world. So that's how I ended up getting into blockchain. And actually, originally I was a commodities lawyer, so I looked at tokenization of commodities for a fintech company years ago, working out how to kind of do the first real proof of concept, and seeing the potential. The blockchain bug bit me, and it was hook, line, and sinker from then on. So yeah, really good to be here, and looking forward to diving into a bit more detail as we go.
Now, let me ask you a question. In the US, it's always been a little bit bizarre to me, but a lot of financial instruments, almost all derivatives, are regulated as commodities and not as securities. Is Europe, London, England, UK, Europe kind of on the same track? Or do they have a different border between the two?
We do have a different border. We have explicit guidance from our national regulator, the FCA, that crypto assets in general are not commodity instruments. And commodity instruments, are not commodity instruments. Now, of course, crypto assets can have certain characteristics that can fall within the perimeter of certain regulated instruments, whether those be, for example, securities or derivative products or whatever they might be. But as a general broad brush rule, a spot crypto instrument does not fall within the definition of a commodities instrument.
That's interesting. In US, there's sort of a default that almost everything is a commodity, and securities, if you want to get really in the weeds, are a specific use case of commodities, or a set within a set. It's kind of
very different. But even in Europe,
I'm not saying that's entirely right. It's just that seems to be the regulatory framework to a certain extent.
Yeah, and we have divergence in Europe as well. We have the same kind of different approach between, for example, you look at what Germany's done, and you look at what's going on in France and other places, complete divergence. But we can dig into that as we go.
Very good. And Massimo Buomo, am I saying your name correctly, sir?
No, Massimo.
No, okay, correct me, and I'll take the hit. What is the correct pronunciation?
It's Massimo Buonomo, which actually means the best good man. So.
Not just the best man, the best good man. I like it. Now, just your title alone, UN Alliance of Civilization, makes me feel like I'm playing a Sid Meier's Civilization game. We'll see if that joke landed with anyone. But just tell us about you and the UN Alliance of Civilizations.
Yeah, I mean, I am a United Nations global expert in blockchain, cryptocurrencies, fintech, and regtech. I am part of a team of global experts of United Nations Alliance of Civilizations. I'm also an international consultant on blockchain and artificial intelligence issues. I am a former university professor of fintech and international finance. I taught in Brazil, in Italy, in China. And previously, in the old days, I was a senior European equity bank analyst in the city of London. So I used to live in London. So I have a wide experience. I worked in financial markets for about 20 years, and then I became a global expert. And I've always been interested in finance, and that's why I got into cryptocurrencies, and then from there into blockchain, and then from the different applications of blockchain, not only in finance, but also in the other sectors, also SDGs, Sustainable Development Goals of the United Nations. So this is something that has attracted me a lot. And what is the most important area nowadays is certainly CBDCs, central bank digital currencies. And this is a game changer, something that will definitely change the way finance is structured. It is a disruptive thing. And of course, I'm looking forward to this discussion about these issues.
Very good. And on that note, let's just dive in. So I'm gonna ask what may sound like a simple question, but I think given the professional and lawyeristic background of a lot of people, of everyone on this panel, it will get teased out quickly. What specifically distinguishes central bank digital currencies from the mostly digital form that currencies are manifested in now? Physical cash, of course, is the vast minority of most currencies out there. What is the exact gap between where we are now and what will make us have a central bank digital currency? What's the minimum things that need to happen? And I'm just going to do it at that order that's randomly appearing on my screen. So I'll start with Joshua. What specifically is the space between what we have now and what needs to be the first central bank digital currency?
Yeah, good question. Well, I think the key factor within this will be who's the issuer of this, right? So right now we have lots of fiat-backed or fiat-pegged stable assets that are out there, whether that's BUSD, USDC, Tether. They come in different shapes and forms. But a CBDC differentiates itself very much by being issued by the central bank. So having a token that is backed by the central bank is a prerequisite for any CBDC. So it would be the central bank, it would be the national issuing entity that would be the issuer of this CBDC. And of course, it would have to take some kind of tokenized form. So, not to spell out the blatantly obvious, the issuer is going to have to be a central bank of some kind. It could be the Federal Reserve in the US, for example. It would be the ECB in Europe. And they would be providing a tokenized version of real money that they would be otherwise, for example, pressing the magic button on their keyboard and printing as they currently do at the moment. So it would have to be a tokenized version of what they currently have now that would be transferable via blockchain technology. And that would allow different levels of, or different types of transfers occurring either between, for example, individuals on a peer-to-peer basis or, between different, for example, states at a nation state level. So I really think the core crux of this is that the issuer is very much the central bank.
Well, you came with three requirements that I identified. It's issuer must be central bank, currency must be in tokenized form, which I think is worth teasing out, but hold tight. And the transfer of that token must be via blockchain technology specifically. So would you say that are those the good body three rules of what makes a CBDC?
I would say, now whether or not it's on blockchain technology or on some kind of different ledger is yet to be seen. But I would be very surprised if a CBDC comes out that isn't on a distributed ledger, of which we already see in the blockchain space right now. So I think those three are kind of very, very high level but core fundamental tenets for any kind of CBDC.
All right, so let me pass this to Johnny, and I'm just doing this randomly in the order it appears on my screen. We're going to have a blood sport. We're going to have like a Hunger Games version where I'm going to throw you against Joshua, and then we're going to bring in the UN's Alliance of Civilizations to like rule the world. Do you agree with that? In the sense that I think I'm okay with the central bank requirement because that's almost by definition. A central bank digital currency probably requires a central bank. Must it be in tokenized form?
I think it has to be in a form whereby the data is structured, and I think we sometimes, unfortunately, due to semantics, and in an effort to try and pigeonhole the topic, we come out with words like token, like unit, like coin, like currency. And I think what we need to look at is, what is it designed to do? And I think at a user level, it's designed to be a payment. Okay, well, you can have a payment in terms of what you historically had was swapping rocks, and then when we learned to read and write, actually swapping bits of paper called IOUs. But I think that what we really need is a form of payment that obviously people can trust and understand and use. And then secondly, what do the issuers want? And I think this is really important in what we now have as a zero rate interest rate environment, whereby there's somewhere between 10 to 15% of an economy typically is the dark economy, the black economy, the shadow economy. Again, it's been given various different terminologies. And these are people that are paying in cash. And these are people who, and entities that aren't paying their taxes. And what governments actually want to try and do is have a better understanding of where the money is in the system. So we have a situation recently where they've just announced in the UK, the Mint, the Royal Mint, is no longer going to be printing or producing 2p coins, because we've got enough 2p coins in circulation for the next 28 years. Why? Well, because the son of a guns have just changed the pound coin. Instead of being circular, it's now got little edges on it. And so many people emptied their piggy banks and went to the bank and actually cashed in their 2p coins, actually said, wow, we've got all this money we'd forgotten was floating around. We thought perhaps it'd been flushed down the toilet or something. So therefore, we don't need to produce 2p coins. And that's a really simplistic example of, I believe governments want to have another tool. They can no longer manipulate the economy by threatening to cut interest rates. But if you do want to go into the period of negative interest rates, then having a digital currency where you start paying for people to make transactions to slow down the circulation of money, having a situation where you want to give increased stimulus, and you've got various calls in the USA at the moment for another 2 trillion on top of the 4 trillion that you've just done. I don't know where this money's coming from, but you found some magic money tree. And
I'm going to change my video background just in honor of what you said. So go ahead, please.
I see you've got a gramophone there, or we call it record player, but there you go.
Everything's fine in the US. Don't worry.
Yeah, absolutely. Just make sure the last person turns the lights out.
Yeah,
but
everything. I'm just sitting here,
just
any resemblance is purely coincidence. Go ahead.
But purely the ability to be able to, this terminology of helicopter economics, which this time last year no one would understand what you were talking about, but has been a very effective tool to actually physically give cash to individuals. But we have a crazy situation where high rate taxpayers, people that don't need the money, have been given the money. We have a situation from a UK perspective where in April, the first month of furloughing, we spent something like 12 billion sterling. And
actually, I'm sorry, Johnny, let me pause you just because I want to must central bank digital currencies be in tokenized form, or there's going to be some data structure is the minimum requirement?
But I don't want to use the word token because we go down the wrong. It has to be in a format that it is structured. The data can be structured. So therefore it can be read by human eye and read by machine eye. And therefore you can then kick in things like smart contracts. But whether that is or isn't on a blockchain, I think is still up for negotiation.
And on that note, Massimo, hopefully I'm saying it correctly. Johnny, I'm just using you as a straw man. You're just gonna, you seem like you can roll with it, or Joshua rather. Massimo, do you see the transactions occurring on a blockchain as being a different requirement? Is it, and to tease it out a little bit more, must the database that it's on, whether blockchain or other, be distributed for it to be a true central bank digital currency? Or what's stopping, say, a single national database, perhaps with different copies, but among different branches of, say, the Federal Reserve or the Monetary Authority?
Well, to be honest with you, I slightly disagree with the definitions being given until now. And I like to be concrete, and that's why I refer to the digital currency that is most important right now, because already being tested, which is the DCEP in China. And the main features of the DCEP are not only of the DCEP, but the general, in general for all digital currencies, is that they are exactly the same as paper money, but it is just a digital form. So it's exactly the same. But it's,
so excuse me for interrupting, but how is that different from the Federal Reserve in the US pushing a button and creating billions of dollars of currency and immediately shipping it off to some bank that can then lend it out? How is that not a digital currency and the Chinese version is a digital currency?
It is, as I said, exactly the same. It is, there are actually two models that are being developed, although the most important one is the second model. There is a one-tier model and the two-tier model. In the first model, digital money is to be transferred directly from the central bank via the social security system directly to a single person. And in fact, the social security system holds all the updated information of the persons. And in fact, in New York City as well, this is being thought because of COVID-19, the money transfers to be done in the US to the people who need them the most, the unemployed, could be done directly via digital currency transfers from the government via social security system to them. So direct payments via the blockchain allow the money to go fast to people according to their updated information. And then there is the second system, which is the two-tier model, where the digital money is to be transferred via intermediaries, which are mostly banks, to a single person. This is the model to be adopted in China, proposed in the United States and in other countries. Of course, banks are not much in favor of the introduction of digital currency because they would suffer the most if the tier one system is adopted in the longer term. However, the companies worst off because of the introduction of a digital currency would be the likes of Visa and MasterCard. And this is the crucial issue. The processing of transactions in the future will not need credit cards, but only digital currency wallets. So in fact, what you
I'm sorry, let me interrupt, because in the US, everyone of course likes to buy on credit, and there's the distinction between a debit card and a credit card. How would Visa and MasterCard as credit providers?
Gordon, that's not correct though. Gordon, sorry, that's not correct. If you look
correct me away, go ahead.
Look at the percentage of turnover, look at the percentage of transactions on Visa and MasterCard, by a long, long way, the majority is on a debit, not on a credit card. So when Visa did their IPO, they stated their competition was not MasterCard or American Express, their competition was cash. So actually most of the transactions that Visa process are actually cash debit transactions, not credit and debit.
I'm happy to be corrected. That's a fantastic point. And if that's true, is it the case that central bank digital currencies are in fact a threat to the Visa and MasterCard model, if the current competition is cash?
They're a threat to all intermediaries because the government can strip out the intermediary and deal direct, and they can know where that money has gone. So when Johnny goes and buys £1 million Ferrari off of Gordon, and then Gordon then goes and buys, you know, a house up in Tahoe off of Joshua, the government,
I love your example so far. Go ahead.
The government knows that trail of money. But if suddenly Gordon goes and buys a 2 million place up in Tahoe, they say, Gordon, where did you get the money from? Oh, well, I did a deal with Massimo. Really? But that deal was only for 100,000. So where's the other 900,000 come from?
Well, we're going to get into the privacy and compliance aspects, but I'm trying to tease out the essential nature of what makes the central bank digital currency different from what's happening now with the digital nature of most currency that's already.
Because you're talking about electronic transfer. You're not talking about digital money. You're talking about electric money. So you're still talking about the same infrastructure. Whereas if you have, that's what I said, if I use the term structured data, so if the actual money is actually in a structured format, then you've got access to real-time information, monitoring, checking, and you can actually use a different payment system, I hate the expression, but different rails. You're not just simply saying, oh, well, I'm going to electronically issue money, Karen, do the same thing to the banks take care of it. Oh, and by the way, the banks, going back to the America, they've actually taken between 1% and 5% of that 2 trillion as a commission. You wouldn't need to do that with a central bank digital currency.
Right, good distinction. So we've all been heading in this direction. So what about obviously the government having complete knowledge of transactions has pros and cons. What about the privacy aspects of central bank digital currencies? And Joshua, I'm going to pass it to you, and then let you know you're the official first questioner of all these things. So go ahead.
Okay. So I think there are a few things to unpack here. If we look at stepping back at the benefits of a CBDC, if you look at what China are building right now, really it's an elegant digital money format that really relies on their own proprietary database. It's not particularly what I would say revolutionary in the sense that it is kind of the most controlled form of digitizing national currency. And don't get me wrong, it strips out, in theory, it can strip out multiple layers of intermediaries, and that will be to the benefit of the general consumer in China. But it's yet to be seen how this will be implemented in a kind of a real world format in a wider sense across China. So we don't yet know exactly what the flow of transactions will be. Will it be to one intermediary that then distributes that to the general population, or will it be through a network of intermediaries? We're not entirely sure yet. There are a few initiatives right now in China that are looking at different models within this. So if we then step back and tie that to the privacy question, I think if I look at this from a slightly different lens, where a lot of the concerns that nation states and regulators and governments have about crypto assets erroneously is the ability for them to be used for nefarious purposes. Well, actually, as Johnny has already said, the fact that you have these digitized forms of value moving around on the blockchain, in theory, for the most part, they can be tracked, they can be audited, you can see what's happening within the system. And if you attribute the right, for example, data sets to them or the right values to them of identity, of who has what where. So in theory, this is a massive opportunity for a government in digitizing their national currency to be able to see exactly where money is flowing and how. So right now, if you look at the most common incidences of, for example, nefarious activity with money, with cash, it can be money laundering, it can be absolutely anything. And the government has zero insight into actually what's happening, apart from when it reappears into the general money supply in form of washed currency. Whereas with digital currency, it gives them this fantastic window into what people are doing and how they're doing it. Now,
let me ask a normative question. Is that good?
Well, that's what I was going to come to. Of course, that throws up privacy concerns. And I think, can a CBDC have inbuilt privacy? Of course it can. And I think if you look at elements of regional regulation and law like GDPR in Europe, it will be obligatory for any CBDC provider in Europe, so the ECB, or any other, for example, the UK that has implemented GDPR, it'll be obligatory to protect privacy. It's
going to be breaking in again, but the history and recent history is replete with all kinds of serious rules being in place and then being completely ignored by individuals who want to check out some girl they're interested in, or governments deciding that they're the good guys.
Well, what about the UK taking all the information under COVID, and they're going to keep the information for 20 years without your consent? Just smash straight through GDPR in the UK, the government have.
Yeah, I think, and there are caveats, exactly. There are caveats like that, for example, public health. There are caveats to GDPR around, for example, law enforcement and public security. So there will always be a way to get around these control mechanisms that we have in place, right? And I think that's just what government.
So with cash,
it's muscle memory.
There's at least the safety that there's not the knowledge. Like it's not just that we're choosing someone's good behavior, ethics, or the system to protect us. With cash, for the most part, it's not physically possible to see what's happened. Therefore, we don't need to rely on a human. It's a trustless privacy.
It's actually illegal in many countries in Europe now to actually transact in cash over certain minimum amounts. And
how do you feel about that?
Well, no, but that's the fact. So if you were going to go and buy a house for, say, $500,000 in France, you are conducting an illegal activity.
I agree, but I am actually asking a normative question first, or as a lead-in, which is that good?
I mean, if I can jump on it,
Yeah,
there
please.
is again, in the case of China, what they say, a balance between a controllable anonymity, which is an interesting concept that the Chinese came up with, and anti-money laundering, counter-terrorist financing, and also tax issues, online gambling, and any electronic criminal activities. So in fact, this issue is quite serious, and everybody is taking its own approach. The thing is that the widespread acceptance of CBDCs has more to do with economy that to do with the control and anonymity of the currency. Because in fact, why has CBDCs been adopted first in China? Because they wanted to. They are a leader in international trade, and at the same time, they have to pay or receive money in dollars, and they don't accept that. That's why they push for the adoption of CBDCs. And another thing I want to mention is that CBDCs do not, in the case of China, for instance, they do not use blockchain. This is an important thing because the volume of transactions is so high, so big that it cannot be handled by blockchain. So this is not a real requirement, and also European Central Bank is thinking about it. They came out with a note about a week ago about the adoption of CBDCs and not necessarily with blockchain. Although I think that the blockchain is certainly the best tool to adopt CBDCs.
But it's interesting, in the Fed statement in August, the actual Fed said they're in active research and experimentation in relation to distributed ledger technology and the potential use case for digital currencies. Given the dollar's important role, it's essential the Fed remain at the frontier of research and policy development regarding the CBDC. I'm sorry, but what a naff.
So let me ask, do they mean it?
Well, they're not. How can they be at the frontier of research?
Well, clearly not. I'm sorry, but do they actually meet? Are they saying this because they have to, from a PR optics perspective, or do you think they're saying this about the blockchain part because they really think that if and when they're kicking and screaming into having a central bank digital currency, that a blockchain infrastructure is the way to go?
Gordon, go. History is a very powerful teacher. If you go back to 1860, before the Fed was set up, there were 8,000 banks, all issuing their own dollar. Now, what I think we're more likely to see is many tens, if not hundreds, of corporates issuing their own payment mechanism. And what's happened with Facebook and Libra, governments have been, not the Chinese, to be fair, because they've been working on this for many, many years before, but the Europeans and the Americans have been forced actually onto the defensive because if an entity that looks after 2.3 billion people brings out a payment mechanism, then all of a sudden we lose control over our money supply and over our people. Because if you look at Facebook as an example, what you can buy and sell and what you can do in terms of gifts and the like, and then you look at someone like Amazon, and this is potentially what's behind all the antitrust thing. So they need to have a digital currency and understand it and be part of it. Otherwise, they face the potential that people will actually say, I'm sorry, but the biggest debtors in the world are actually the governments. Why do I want to continue to trust the governments that are basically bankrupt?
Well, I'll give you a little anecdote. So the last one of these shows, the Democracy for All show, I attended live, and I got to shake John McAfee's hand, and unfortunately, I don't think I'll be able to do that again for a while.
Did you count your fingers afterwards?
Say again?
You count your fingers afterwards?
Yeah, I did, but I started with 6, so it was fine. So I literally for 3 months gave presentations about Libra, and this is back when we could travel. And as part of my research into Libra and its model and why the government was so resistant to it, I actually went to the Libra Network's headquarters in Geneva. There is no Libra Network's headquarters in Geneva. It's all PayPal, actually, and it's in a co-working space. So it was kind of funny to see, and pictures of me breaking into the Libra headquarters. So I'm not sure, that these corporate replacements for global currencies are necessarily more reliable than the national ones. I'm not hating on them, but the complaint about Libra was that it was going to become the equivalent of a special drawing right. He would be abstracted away from these national currencies and these national bonds and have Libra backed by a bucket of these currencies, not exchangeable for, but backed by. And of course, when you have, if you were to count the population of Facebook as a country, it'd be the largest country on the planet. And I was actually very surprised to see the number of Indian users of Facebook. Of course, China, not so much, for obvious reasons. And there's all these kind of arguments about, bringing finance and bank-like, access to the underserved South, which I thought was a little paternalistic. But then you show up there and it's not even an office. It's sort of legislative or branding. But now, of course, it's more than that. I'm overplaying it slightly. But I'm not sure what's reliable. Whether yes, we have these nations back, running on debt right now. But what are these companies running on? These companies act still within nations. They're not DAOs. So what is safe?
It's a fair point, but I think it's choice, right? This is a healthy development. The fact that we can talk about, whether corporates or nation states, central currencies or digital currencies are better than the other. I think the fact that if we get to the point that we give people choice, that's a good thing, because at the moment people don't necessarily have the choice. All they have a choice of is their paper currency.
Right. So let me interrupt you, but then continue. Does that choice undermine national sovereignty, and is that a good thing? Do we care?
I think I'm pretty agnostic from a personal perspective, but I can understand why nation states would be concerned, because it removes one of the core tenets they have, which is control over the means of payment that their populace uses on a day-to-day basis. And bit by bit, that's been eroded by various mechanisms, peer-to-peer cash transfer mechanisms, whatever it might be, but they still feel they have control.
Sorry, but also to John's point, it kind of removes the ability to do a Keynesian stimulus of the economy.
Well, they've lost that in any case with zero interest rates.
But the problem. Absent central bank digital currencies, that zero interest rate environment may be temporary, right? Well, but may. Okay, but with competitive currencies, you may lose it forever.
Yeah, if I may make a comment about Libra and WhatsApp, there is a serious problem about regulation as well. Why? Because Facebook with Libra and WhatsApp and other non-financial players are effectively using financial players like Visa and banking system to make payments. Now, where is the problem? The problem, let's say, is in practice, for instance. If I pay with a bank account, I instruct the bank to make the payment. If the bank does not do it, there are tons of law provisions which protect me. This is not the case for payments via WhatsApp, because in those cases, if I instruct WhatsApp to take my money and make the payment to a third party, and then they don't do it, I can only enter legal proceedings against them. Yeah. But I do not enjoy the protection of using a financial company. That is why there's a need for regulation for Facebook and WhatsApp. And that is why, for instance, in Brazil and in India, Libra had so many troubles, specifically WhatsApp had many troubles in the adoption by those countries. And also there's an unfair competition from WhatsApp compared to the other players, other chat applications. So, I mean, this is a serious issue that...
so what is the nature of the unfair competition?
The unfair competition is because WhatsApp is a major player in Brazil vis-a-vis the other players, like Telegram or all the other players that have the same features as chat applications. So
why is that unfair?
Well, because they have a competitive advantage compared to the other players. In fact, the Financial System Organization and Resolution Director at the Central Bank of Brazil said it was okay so long as tech companies behave themselves. This is an interesting concept.
Sorry, to be real clear, not unfair competition vis-a-vis regulated payment providers. Why unfair competition vis-a-vis other chats with similar functionality? Or did I misunderstand?
Because in Brazil, they are the major players. I mean, WhatsApp, everybody uses WhatsApp, while the other players have not and are not on the same standing on equal footing with WhatsApp. So this is why they take advantage of their market position to make payments, and this is an unfair competition with the other players. That's the definition of Brazilian central bank.
Okay, I'm going to sound like a complete American, but if they're number one in the market, maybe that's because they're doing a better job. And
Yeah,
I'm still missing the unfair part.
You create a monopolistic situation, so you have to get around that.
I guess, yeah, it comes down to that, right? That they have a dominant market position,
Exactly.
and if you give them another really transformative and powerful tool to be more and more dominant with, it crowds out the rest of the market. So I think there's always that competition element that especially Brazilian regulators are always looking at.
If they have a monopoly or a quasi-monopoly, I get that argument. If they got to majority position by being first or being good, and are maintaining it by being good, to me that's a little bit different. But you're right. That's the problem with Facebook. Sometimes it can be, there's an argument that in tech, in some areas, there's natural monopolies. Like, how many video channels do you want to go to? I just want to go to YouTube. I want to see it all. How many social interactions do I need? I don't need 400. How many chats do I need? I'm drowning in chats between WhatsApp, Telegram, Facebook, and all this other stuff. I wish there was just one chat window. So I think there's an argument where you get beyond geographical space, that sometimes consumers are best served by a single provider, but of course that has all kinds of market power and privacy and innovation consequences. So I think it's tough, but I think I saw a comment. Go ahead.
A lot of the privacy issues, technology can help overcome that. So in the States, you can't drink till you're 21. Yet for some reason you can drive a car.
Oh, you certainly can. You just can't do it legally.
Well, you can't do it legally. You certainly can't do it in California. You can't even walk down the street having a beer in California, but that's a different issue. But you can drive a car at age 15. So if you want to challenge me, and for years I've gone to the States and say, well, I'm sorry, we need ID. I say, come on, give me a break. I'm over 21. Don't care, need ID, because if the restaurateur or the bar owner gets busted. Now my point is you don't need to know that I'm actually 57. What you do need to know is that I am over 21 or over 15. And so technology can actually share information that's relevant to the relevant party on a permission basis. And bear in mind, the title of this event is democracy. And currencies is just one element of this. And I think that probably as bigger issue or as a bigger opportunity is the use of technology. And we need to get away from crazy politicians, and we've all got our fair share of those. Many of them have had COVID, funny enough. But my point is,
them still have COVID.
Well, no, he doesn't wear a mask anymore. Sorry, you're talking about Boris. But no, we'll move on. But my point is that actually we trust these institutions and these banks. Well, look, we've just money laundered 2.3 trillion out of London in the last 20 years. So those so-called trusted entities has to have a question mark. We look at the way the banks have carried on. We look at the World Health Organization. These bastions that we thought we could rely on trust on actually have proved wanting. And it goes back to Joshua's point. Give people a choice. Give people the opportunity to say, actually, do I want to hold bankrupt countries, or do I actually want to hold one of 15 companies in the S&P 500, which is Facebook, because all the others are in net debt, because I actually want to hold my money maybe in something that's actually backed by something, albeit by potentially fiat. So I don't think it's a matter of right or wrong. I think it's more a matter now technology can allow choice.
Okay, now let me throw good point. I'm going to throw this open to the whole group. Will traditional banks and the traditional banking system survive and have at it? First one to speak speaks.
Yes.
Yes. I agreed. I cannot.
Will they change? Yes.
Yeah. They're not going anywhere. They're not going anywhere. And they can't go anywhere. And also they will have, as any incumbent does, the first pick of the pie when something systemic or something gets built by a nation state. So if you look at all the people who are working with, for example, national, governments and central banks to investigate and explore central banks, the CBDC, it would be a large technology provider that is working already with lots of the systemic financial institutions that we have at the moment, they will follow suit. They already are. Lots of them are building in stealth. Lots of them are participating from afar, but they're building behind the scenes. They will be very much involved in this evolution. They know they have to evolve. And if they see in markets that there will be some kind of liberalization of the way that money is sent and the means of payments have evolved in a new way, absolutely financial institutions will have a piece of that pie. They're simply too powerful and too large to not have a piece of that pie.
So let me throw this at you.
It's really important. Snapping the heels are your friends on the West Coast want to take a big bite out of the apple. And look what's happening with Apple, Facebook, Microsoft. Look at all those companies, Amazon. They're turning themselves into fintech businesses because their native business, they can't carry on growing at the same rate. But if they can start attacking financial services and stripping out the costs of payments and potentially offering other value-added services, look at Ant. It's going to be the biggest IPO in the world about to be floated. It'll create a company that's in the top 20 of market capitalization. And they started with a very, very simple payment using QR codes. Then I've got 900 million clients, and they offer a whole range of insurance and investment type products. Now that, with $35 billion in cash, that's the company I would be worried about as a Western asset manager or bank, because they've already got the digital infrastructure. And now what they can do is start pumping product, and they've already signed up the deals with a load of Western banks to use their platform.
Indeed. So let me ask a follow-on to what I asked, a little more pointed. Will fractional reserve banking survive in its current state? Will it evolve, or are we going to something else?
Well, if I may answer that, I think that banks are identified nowadays with payments, in a sense that the general people in the street, I never go to banks, for instance. I just go to cash machine to get money out of the cash machine. What is the use of a bank for me or for anyone in the street? Is just to cash to make payments. Now, if I can do it via a digital wallet or a digital currency, why should I go and pay a bank for that and make payments and pay fees to banks? So there is no need to have banks, as long as they don't give you a value-added service.
Well, let me break in. I think there's a benefit. At least one of their functions is capital aggregation, so they can make loans. Even if I have tokens or currency in my own wallet.
Gordon, they're not very good at doing that, though, are they?
Well, okay.
When you go to a bank, and you'll say no.
Well, hold that thought for a second. Okay, and I'll even qualify by me saying commercial loans. Right,
okay,
and
so look at the commercial loans in the States. And you've got 90% of companies in America are SMEs, small to medium-sized businesses. The banks don't want to touch them with a barge pole. All they're interested in is lending money, creating debt instruments for the likes of Apple and the other FANGs, because they're seen as low risk. But the biggest employer, the biggest revenue generator in your country and across Europe and across Asia are SMEs. Banks don't like SMEs because they don't have the skills and the staff to understand those businesses. We've got rid of our bank managers. It's all done by algorithms.
Let me distinguish between investment banking and traditional commercial banks.
I'm talking about commercial banking. If you want to get involved in investment banking, we're back into asset management, where we're going to see Joshua's market, the derivative market, that's about to be digitized. You're going to see the whole...
Let me frame this way. Would you agree that the traditional role of a bank is to aggregate capital and make loans?
Not necessarily.
Well, of course, look, we're all lawyers, I guess, at heart. Yes, of course, not necessarily. But a traditional role of a bank was to aggregate capital and make a loan?
Yeah, they were quite good at taking money from old grannies and then paying them a paltry interest rate and then lending a huge amount of money and taking massive bonuses and huge corporate offices. A very, very inefficient model. Unlike
if I strip
if I may, Sabine, you have to remember that lots of loans are guaranteed by government in some ways, and that is an important part of the loan business. So, I mean, if the government gives a guarantee, what is the value added of a bank? Why do you have to pay a bank For instance, if I have to make a money transfer, I have to pay a bank for doing that to take
well,
my money.
you're back at payments, and I'm actually not arguing that point. I love the
But
fact that
even
we
in the loan business is a heavily regulated business, and a large part of it is guaranteed by government. If that is the case, where's the risk that the bank is taking? Nowhere.
well,
So
in those
why should
cases,
you pay? Yeah, why
right?
should you pay a bank for that?
I mean,
in those cases,
In those cases, yeah.
well, and again, I guess the question is, why are we paying the bank?
Exactly, that's the question.
No, but hold on. But if
I mean,
I've yet to hear anyone address the specific point
my
of
point is
capital
that
aggregation and loan making.
my point is the following.
Yes.
With the blockchain, AI, IoT, there is elimination of intermediaries. If you don't give a value-added service, there is no need to pay you for that. And the intermediaries like banks, financial institutions, most of the times do not give any value added. That is the point. Then you can take CBDCs, you can take fintech solutions, AI, whatever you want. But the basic point is, where is the value added of your service as a commercial bank or an investment bank? If there is no value added, because that can be done by machine, by AI or blockchain, then there is no need to pay you for that. And that
Okay,
is
are we in a situation where capital can be sufficiently aggregated so that these large commercial type loans can be made out on the blockchain? I haven't seen it. I've seen lots of proposals. I haven't seen it happening
Okay, so
yet.
Gordon, are you familiar with Westpac, ANZ Bank and Commonwealth Bank of Australia have just done with the owners of the huge shopping centres, Westfield shopping centres? So on the blockchain, last month, they are now issuing bank guarantees in 1 day, as opposed to 1 month. So that's just another little example of a lucrative area of the banks were creaming it and creating huge inefficiencies. And now they said, actually, it's better for our client. We make more money out of it because it's actually more automated. And so you're seeing bank guarantees coming out of Australia with some of the biggest banks and actually making the whole thing a much, much more efficient process. That's part of your capital flows aggregation. But I think you need to look at, why were the banks there? The banks were there to act as like on a branch level. They were sources of distribution. You couldn't just phone up and say, I need a loan. No, if you want a loan, come in and see the bank. I want to make a deposit electronically. Well, you couldn't do it. You had to go along with your piggy bank.
Guys, I love the spicy conversation, but I want to be clear that I'm not making any kind of advocacy for, I think you're mishearing me.
No, I think you've got banks as clients and you're just squirming a bit now as a moderator. It's quite interesting to see it.
I don't have a single bank as a client, and actually I went back in the law to take them down. But I love being devil's advocate, and I love that you're messing with me. It's cool. You're not one of my buddies, okay? Because we should talk, pardon my French, nonstop. But I love being devil's advocate, and I was also on a panel yesterday. I still want you to respond to the specific point I'm making, which is not a general pro-bank statement. It is a specific narrow point that banks have traditionally served some role in aggregating capital and making large loans in a way that it was inefficient for smaller capital owners, if you like, to engage in. And so that one intermediary function, I think, may translate well over to this new blockchain digital world, simply because there's going to be a role for someone to make large loans, and not individuals may not be able to do that. Maybe that becomes AI, maybe that becomes something else.
Yeah,
but I'm saying that function of the banking system may persist.
Yeah, it's all technology driven. I think, the aggregation of capital and the subsequent distribution of that was done in, up till today, and continues to be done in that way because of technology being what it wasn't for, the vast majority of human history, where you simply had to have these intermediaries and these layers to be able to fulfill certain functions that were mainly organized on pieces of paper and face-to-face meetings, where now technology enables us to strip out all of the manual face-to-face bureaucracy that previously took place and enable capital to move in more efficient and dynamic ways. One example, if you just take the UK as a case in point, the peer-to-peer lending market now, the growth of the lending market in the UK on a peer-to-peer basis is ballooned over the last few years. And don't get me wrong, there are some teething problems with that. We've shifted counterparty risk, from institutions to peer-to-peer, which has its own challenges. But nonetheless, it comes down again to choice. It gives people the ability to generate yield on their cash by lending it out to other people in an almost not trustless way, but in a way that disintermediates the normal kind of lending process. And people now have the ability to do that. And if they want to take that risk, they can take that risk, and they can generate a better yield than giving their cash to the bank. The bank then sits on it, gives them a crap interest rate in return, but the bank then goes off and lends that for juicy lending rates to their commercial clients, for example. So this whole trend of disintermediating via technology, I think, is a welcome one. And I think blockchain will further enable it. Albeit slower than we want it to, it will further enable it over time.
But Gordon, we're already seeing this with the DeFi. The DeFi started out around swapping of tokens, but now a big sector of DeFi is actually lending, and you got yield farming, and basically instead of putting your money in the bank, instead of going and buying US Tether, assuming it is actually backed by dollars, and actually earning no interest rate.
I always make that comment. Yes.
No, come on. Look at the New York State Attorney. He's the one that's calling the shots, not me. But my point is that you're already seeing aggregation of capital. And whilst DeFi has been around for 3-4 years at least, it's only been in the last 2 or 3 months that it's gone from an asset base of $1 billion to 14 billion. Now, it's not going to carry on growing at that rate, very, very unlikely. But my point is that we may well see aggregation of capital in a decentralized manner, which will enable people to tap into capital sources. But what's stopping it, perversely, is things like custody, being able to safeguard assets. What's stopping it is lack of clarity around regulation and the law, which is the EU have come out 2 weeks ago and saying we need to give clarity around regulation so that people can have proper definitions. So the infrastructure is still very, very immature, but as that matures, I cannot see a situation where you continue on one side have a paper-based system and on the other side have a digital-based system. One or t'other will not survive. And if the paper system cannot give the regulation and the controls that the digital system can, I think that what will happen, the compliance will actually drive the actual adoption in the same way the cyberpunks have gone, and it's now top down, not bottom up. It's governments that are driving the digital agenda if you look at all the stuff that's coming out.
We're down to 3 minutes. I'm just going to throw this out to the group.
Yeah.
Will the U.S. cross the chasm into having a central bank digital currency, like a true one? Will it actually happen?
I think that the U.S. will eventually adopt the digital currency, but I think that they are the last ones in the queue because there is a resistance from the banking system. This is what is dragging the fees in the U.S. because if you see, the U.S. has always been at the forefront of innovation, but in the case of digital currencies, this is not the case, and this is striking, I would say.
Other gentlemen?
Well, if you look at
will the U.S. cross the chasm to central bank digital currency, a true one?
Look at what Christian Lagarde, ex-MD of the IMF, said. I believe we should consider the possibility to issue a digital currency in Europe. There may be a role for the state to supply money in a digital economy. It's the second biggest economy in the world, Europe is. Unfortunately, I think Massimo is absolutely correct. The leadership in the US in the financial service sector is actually, they're past the baton over. China have already got one, Europe will have one, and then America will be forced to have one.
Agree. I fully agree with that. They're not going to sit on the sidelines for too long, but they will be slower than others, including Europe, in actually implementing it. They will be seeing corporates like JP Morgan putting in place their own version of a means of payment that is digitized. And when they see that happening and they're not getting their act together, and they see all the other large economies putting in place CBDCs, their hand is forced and they have to do it.
And then I'm going to throw a final question to the group, which is when, if you had to call a year, when does the U.S. stop being notice the definite article, the global reserve currency?
There is no deadline for that, but
no punting. This is a gentleman's wager over nothing. So if you have to say a year, what's the year?
Gordon, you've asked us the questions. When do you think, being a Yankee Doodle dandy?
I think
2030.
I think 2027.
2030. Let's make it bad.
Huh?
2030.
No, 2027. Or you're saying 2030? Okay.
Yeah.
I think you know, everyone always says that the dominance of the dollar is based on the fact that oil is priced in dollars. I'd actually say that the dollar is priced in oil. You know, if you want to really look at how the world works, and because China is buying the majority of Middle Eastern oil, is only going to take in more, and other countries are India as they develop more are going to suck in more. It's just a matter of time until the majority of oil is not sold in dollars, and when that happens, and our fleets are not in the Middle East, and or there's a tussle between the U.S. and China that the U.S. does not come out clearly ahead in, any one of those can kind of push it over, and there's a gradual erosion happening anyways. I think I'll throw in also, I think COVID-19 has done two strange things. It's accelerated history, the fact that we're having this conference digitally right now, and this is normal and not like our fallback, but this is just assumed. It's accelerated history, but it's also put history down a different path than would have happened already, which is rare. Normally things just speed up or slow down in history. This one, I think, put us down a different alley slightly. And in this different alley, it's hard to see the future, but I'll throw out 2027.
Okay, so, you use oil. I think the new oil of the world economy is actually data. And that is
why I hear that a lot, but you know, your data comes over a network that fundamentally has electricity behind it.
Data. It's not aluminum, it's aluminium. It's not cilantro, it's, you know the stories. Scallions.
Yeah, it's two people divided by a common language.
The Queen's not happy the way you bastardize her words.
Well,
tough. Joshua, what year?
You know, I'm going to be a contrarian here. I do not think that the US will lose their domination, their dominant position as the reserve currency. Maybe we will see reserve currencies in the future where there will be a slow but steady block of people moving away from the US dollar, and we all know who those will be. But the US will still, in 2030, I believe, be the dominant reserve currency.
Brave, I like it. Johnny, don't hit me with rhetoric. Just give me a year.
I think that what you'll see is a world reserve currency based on equities, bonds, properties, and fiat.
Fantastic. When will the U.S., if it does, lose its position as the reserve currency? What year?
It'll lose it in the 21st century.
In the 21st century, well, we're in there. You know what? You guys are all officially now buddies because I love this fight. But I think we're out of time, unfortunately.
That's a story for another day.
Say again?
That's a story for another day.
It is. Okay, you were all great. I really appreciate it. I appreciate the time. You know, I appreciate the insights, everything. And my hat's off to Democracy for All, D4A, for making this happen. And see, our lovely hostess, is she there? Was it Lisa? Who knows? But anyways, all of you, thank you for making the time. Really appreciate it. That was a good panel, lots of good insights. So have a good day.
Thanks, guys.
Thank you very much, guys. Thanks. All the best.
Bye.
Thank you very much.